Gentlemen, the recent results for the Aspen Parks Property Fund have been disappointing to say the least. Clem, can you articulate what has happened?
The dominant change over the last 12 months has been the resources cycle. It has moved away from being in the construction time into the operating time. The parks are still profitable, but far less profitable than they were before. You can see in this chart that the income from those resources parks has halved over the year. You can also see that there's been a slight decline in earnings from the resorts properties. Conversely, the income from our permanents and tourism parks are higher. We've been able to manage to reduce costs. But overall, the impact of this decline in the resources parks has been the overwhelming factor, and that's driven lower earnings over the year.
There's also been a decline in the net asset value.
Yes.
Is this related to those earnings?
Absolutely. The valuation approach is to look at income and to have that capitalised. And clearly, when we've had such a massive fall in the income from those resources parks, those valuations of those parks has declined. But in addition, as you can see in this chart, like the income in the resorts properties, the valuation of those resorts properties are down. And also in a few of the other parks, we've had some capital expenditure which hasn't been generating income over this past year, and that's resulted in a slight decline in a few of those parks as well.
Let's talk about those valuations, Phil. Who does these valuations?
So the valuations have been completed by independent valuers across all the properties for this time, and that's consistent with our valuation policy that really hasn't changed for a number of years, where we assess the valuations on a quarterly basis, and where we believe there's substantial change that warrants an independent valuation, we progress to that independent valuation. And in this case, we did all the properties at once. I mean, we have done that once before, back in 2009, when we think there was enough change to warrant that. We did that this time. Those valuations come in and are assessed by our investment committee, and then that's put forward to the board in terms of preparing for the half-year accounts. And that was the process we followed, and the valuation policy going forward again remains unchanged, and we continue to assess them every quarter, and certainly as a minimum we do them independently once every 3 years, sometimes more when we feel it's necessary.
And talking about going forward, Clem, what about the prospects for the fund moving forward from now?
Yeah, well, certainly the last 12 months has been challenging in terms of the income and the valuations, and clearly the debt side as well. But when we look at the longer term trends for this industry, supply has been structurally falling, demand continues to rise with the economy, and therefore occupancy rates are structurally higher. In addition, we've got these really strong demographic trends which are very important and very positive for our permanent resident side. So the industry trends have been very positive. And of course we're working at a management level to improve returns all the time.
Phil, can you give us some examples of some specific initiatives that you're actually working on at the moment?
Yeah, sure. We've been looking at quite a number of the, operational aspects of the business to see how we can change them and improve them, and I guess any business would always be doing that, looking for continual improvement, and we've done that. One of the key things we've looked at in the last sort of 3 to 6 months is how we can improve our marketing effort. Clem talked about the earnings coming down, and generally that's been driven by a fall in revenue, not so much costs. So it's very much a revenue business. We believe we need to look harder at that sales and marketing function, and in fact we've recently appointed a new sales and marketing manager, so her tourism and hotel experience we think will come to the fore. We've also decided to look more closely at the resources parks that have seen the majority of the fall, and have a specific focus on extracting business out of those properties. So where most of our sales and marketing team would be tourism focused or based, we have got someone in there with a different set of skills that will try and extract more and more revenue out of that resources area, which is a lot more competitive these days. We also want to recut our website, for example. The way technology is changing, people using mobile phones and tablets and things like that these days as they travel around. We need to make sure our website is very accessible and very easy to use, so we'll be doing that. We'll also be looking at things such as, obviously, costs. I mean, as we always do and should do, and just continual ways of where we can trim any costs and keep our earnings up. So they are some of the, key things, and there are other, more just a range of micro things that we're doing to ensure that we can try and, get those earnings up for the investors' benefit.
Yeah, and just finally, Clem, obviously it sounds like you're still very much committed to the fund. Is that how you see it? Are you very optimistic?
Oh, absolutely, very committed to the fund. Yeah. Aspen Group is the largest investor in the fund. So we have a major co-investment in the fund that aligns our interests with all of the other investors. We've also announced that we've reduced the asset management fee through this period of time. And Aspen Group generally has made public comments about the positive attributes and positive trends that we see in this value for money accommodation industry. So yes, we're very, very committed and very focused on turning around the performance of the fund.
Gentlemen, thank you very much indeed.
Thank you.